Hello, Wealth Masters. My name is Greg Phelps, and I am your host of the Wealth Summit. Our mission at the Summit is simple. We want to educate and empower you with actionable tools, tips, and tactics to help you grow, protect, and maximize your personal wealth. Today, I have Don Graves with us, and he's going to explain the 5 ways that reverse mortgages have changed retirement income planning forever. Don, are you ready to help us master our wealth?
Greg, I'm ready and willing and able, so thanks for having me.
All right. So for the Wealth Masters out there, a little bit about Don. Don Graves is the president and founder of the HECM, or HECM Institute for Housing Wealth Studies, and an adjunct professor of retirement income at the American College of Financial Services. He's considered one of the nation's leading educators on HECM reverse mortgages in retirement income planning. He has nearly 2 decades of experience, which has led to more than 14,000 advisors enrolled in his teaching classes. And his personal practice has generated more than 12,000 HECM consultations, leading to over 3,000 or roughly 3,000 clients. Don has been quoted in Forbes, Reverse Review Magazine, the American College Magazine, and has been featured on PBS sponsored shows, as well as other venues and programming. He is sought after as a professional speaker regarding the changing face of reverse mortgages and how they can seamlessly integrate with a comprehensive retirement income plan. He holds an undergrad degree in finance from Temple University, as well as graduate studies in economics at Eastern University. Don resides in the greater Philadelphia area, is married, and has 3 children. Don, that's quite an impressive bio. Why don't you take a second and fill in any blanks that I might have missed, and then we'll dig right in.
Well, there are not too many blanks to fill in here, Greg. I'm proud to say that my family is from Kentucky, and so those who are listening today, you may see some of my Kentucky sensibilities come out. I tend to simplify, summarize, and synthesize. That lots of ways you can. I asked my daddy, where does milk come from? He said the store. that may be a little too simple, but I like to. Brown cow ate green grass and produced white milk, and so we're going to keep it right on that level, talking about reverse mortgages today.
Don, that's perfect, and I'm going to tell you, I'm going to come clean here for the viewers out there. Up until a few years ago at a conference, I really didn't have a whole lot of reverse mortgage knowledge or education, and all I can say is thank goodness I spent the time to get educated, because I am really a big proponent of these for the right clients. So, Don, let's go ahead and get started and talk about what exactly is a reverse mortgage.
Fantastic. Thank you so much, Greg. A reverse mortgage in times past was a good way to destroy a good barbecue
okay.
if you weren't careful. And let me answer that question about what is a reverse mortgage and combine it with the second thought was why were they created? This is a very important idea because it fits into the concept of retirement. And retirement has always been in 2 phases. For those who are listening, you all may know this. There's climbing up the mountain. Think of Mount Everest. And that's kind of getting to the mountain. That's your accumulation side. And hopefully you work long enough, you weather the storms and trials, you make it to the top. And the prevailing idea is you plant your flag, you hit your number, you said, I made it. Well, that's one part of retirement. The other side, which is coming down Everest, and 2/3 of the people who died on Everest died on the way down. That's far more dangerous. That's after you've retired. Now you're living off of what you saved, and there the risks can get pretty heavy, Greg, as you know. And so 4 retirement concerns that we're seeing for retirees, and this will lead into how the reverse mortgage came about and what it is in particular. And so they all begin with L. The retirees have a concern about longevity. You've seen those commercials. How long will my money last? Will I run out of savings? Longevity. Number 2 is lifestyle. Will I be able to live life on my own terms? Will I have to cut back my lifestyle so drastically that I no longer enjoy retirement? Number 3 was legacy. How will I be financially remembered? And number 4 was liquidity. Will I have money, access to tax advantage money when I need it? So those are the 4 retirement concerns coming down the mountain, and advisors traditionally have had to work with 3 buckets of money. Your income, that's Social Security or pension if you had it, your investments, and then the 3rd bucket I call insurances. That includes annuities and insurances, a business you're going to sell, a second home, something that you can rely upon. Now, here's the question. And the day that we're living in, where people are living longer, they've not saved enough, and they're highly indebted, do those three buckets work? Just the income, investments, and insurances? And the answer was no. No, we needed something more. So in 1961 in America, the first reverse mortgage came about. Its intent was to help people to prepare for a very long, there was my camera, long retirement. And that we're going to live longer than 50, 60, 70, 80. It's not uncommon to live 90, 100, 110 years of age. And so we needed something more. So reverse mortgages were designed to help retirees to prepare for a very long retirement and allowing them to use an asset that most retirees have. 87% of retirees live in and own a home. How do you get money out of that house? Well, you could sell and move, or you could take out a home equity loan or mortgage and make a monthly payment. But if there were a way to use that asset to sustain and supplement what would be a long retirement, that would be a winner. So that was why reverse mortgages were created. The question, well, what is a reverse mortgage? Hey, Greg, I'm going to give your listeners 4 words. 4 words. There's my camera. 4 words.
Okay.
And if you can understand these next 4 words, folks, it'll save you heartache at the barbecue, at fork, or whatever you may go through. It's going to save you a lot of heartache. Here's what a reverse mortgage is. 4 words. It's just a mortgage.
Okay.
It's just a mortgage.
Okay.
Now, some folks, they don't believe that, Don, that's not true. It's more than that. No, it's just a mortgage. See, underneath the hood, it's just a mortgage. What's the difference? A reverse mortgage was started 30 years ago as part of the federal government, 1961 as a private program. It's simply a home equity loan for those aged 62 years or older that allows them to convert a portion of their home's equity and turn it into tax-free money without requiring them to move, to give up ownership of the home, to transfer the asset away, or to make monthly loan payments. That's it. It's just a way to access the equity in your home without the burden of making a monthly mortgage payment. That's it in a wide definition. Now, as we go forth today, I'll unpack that a little more. We'll cover a few more things, but that's it in a nutshell.
It's just a mortgage.
It's just a mortgage.
I have a question for you, and I'm curious because I may very well misstate this when I discuss these with people and friends, family, and clients. Is there a difference technically between a quote-unquote reverse mortgage and the HECM or HECM?
The common term for a reverse mortgage, the common term for home equity conversion mortgage is a reverse mortgage. So the legal name,
right,
1988, is the home equity conversion mortgage, HECM. The common name has been reverse mortgage. Now we're moving back to the HECM terminology because it's really very dynamic. I will say this to the listeners. And I got my first cell phone, Greg, in 1997. That was 20 years ago, and I thought I was somebody. I thought
it was about this big.
Oh, it was something you carried in the desert of Iraq or somewhere. But I thought I was the man, and I would sometimes pretend I was calling somebody, and it only did 2 things, folks. It made calls and received calls. That's all it did. It didn't tweet, text, nothing. Now, my son, who just graduated from high school, he got his phone 4 years ago. Now, I've seen him do a lot of things on that phone, kill Angry Birds and watch videos.
Right.
But it wasn't until 3 days ago that I actually saw him make a phone call. He pulled it out, and he pulled it out in the car, and I looked over and said, "Hey, what are you doing?" He's out making a call. But here's the point. To compare my son's 2017 mobile device with 3.9 million applications,
right, to
my 1997 cell phone would not be no comparison at all. The reverse mortgage that most people have in mind is like my 1997 cell phone. Today's home equity conversion mortgage is like today's mobile device. Its usages and its strategies are really dynamic.
So it is essentially the same, just we're kind of reverting back to the original terminology, I suppose, but most people just generically think of them as just a reverse mortgage.
Sure, that's fair to say.
Okay. So great. So tell me a little bit about how do I know if I qualify? Who can actually get a reverse mortgage?
Sure. So the reverse mortgage, there are really only two programs that the federal government supports and undergirds for retirees. One is Social Security,
Mhm.
and the other is the reverse mortgage program. Started in 1988, so coming up on 30 years. It was designed, again, to help those in retirement to sustain what would be a long retirement.
Mhm.
So it's for those who are age 62 years or over. Now, only one person has to be 62. So you can be 65 and your spouse can be 25. The other person only has to be of legal age, 18. So for those 62 and over, one of them, on your primary residence, and it's allowing you to convert a portion of that into tax-free money. And so that's who's eligible. Now, since 2 years ago, there have been some improvements in the program in the sense that we now want to make sure that the people who get a reverse mortgage have the wherewithal to maintain their home and have residual income. So there's a financial assessment test to make sure that you have enough money left over at the end of the month to cover your property related expenses, taxes, insurance, things of that nature. And we want to make sure over the last 2 to 3 years you've been a good credit citizen. You paid your mortgage on time, your property taxes on time, and things of that nature. So those are the two most important qualifications. And
Mhm.
based off of that, your age, value of the home, a certain amount of money is going to be made available to you.
Okay, well, that's a great transitional topic there because right now I'm
Uh,
really curious, and I know this is a very vague question, and it depends on probably age and interest rates and value and how much I might owe on the home. Just
uh-huh.
share with me a little bit about how much money could I actually get?
Sure. So if what it is, a triangle or something that Jay-Z uses, I would just
Okay.
or Cam Newton, I don't know, one of those superstars, but it's a triangle. So I want you all who are listening to think of the amount of money that a reverse mortgage makes available is based off of these three things on the triangle. Number one, the age of the youngest borrower. That's the pinnacle of the triangle. Number two, the value of the home. And number three, the current interest rate. So those three things make up the criteria by which we determine, or FHA determines the amount of money that's going to be made available. So
Mhm.
for a typical 62-year-old today, at the time of this taping, they're eligible for about 50% of the value of their home. And so if you have a $200,000 home, you're 65 years of age, you're eligible for $100,000. If you've got a $400,000 home, you're eligible for $200,000. Now, there's a lending limit. The lending limit is HUD says, here's the maximum amount of money we're going to value your home at. Today, it's $636,150.
Okay.
So if you have an $800,000 home and you're 65 years of age, you'll be able to receive about 50% of 636,150. So
Okay.
about $317,000. So those are the three criteria of the reverse mortgage, the three building blocks: age of the youngest borrower, value of the home, and the current interest rate associated with the program.
Okay. And when you say the current interest rate, can you explain a little bit? Let's just say that interest rates were more quote unquote normal, if there is anything normal with interest rates in the marketplace. And let's just assume that government bonds are paying 5 or 6%, so the rates are higher than they are today. Can you get
Sure.
more out of your HECM or less?
Sure, because the reverse mortgage is just a mortgage. If someone's listening, and if I said to you, how much house could you buy with a regular mortgage if the interest rates are 3% versus 10%? They say, well, Don, I wouldn't be able to buy as much or get as much at 10%. I said, that's right. And I said, with the reverse mortgage, now we're in a low interest rate environment. You get more money with the reverse mortgage. If interest rates begin to creep up, then you get less money with the reverse mortgage. So now for a lot of folks, it's proven to be an optimal time these last several years.
Okay. Because rates are really low, so you can actually get more out of it.
That's right. That's right. Absolutely.
So it's based on interest rates, it's based on the age of the youngest borrower, and it's based on the value of the home. Now, let's just say, Don, let me throw you a little wrinkle here. Let's say I've got a
Okay.
$400,000 house, but
Yes,
I
sir.
owe $200,000 on it. What are my options now?
Very important. Thank you, Greg, for asking that. A reverse mortgage must be a first mortgage. So any existing liens, loans, home equity loans, second mortgages must be paid off first from the proceeds of the reverse mortgage. So in that example, if a person had a $400,000 home, they're 65 years of age, a reverse mortgage makes around $200,000 available. Their mortgage, if it's less than $200,000, that's great. The reverse mortgage makes enough to pay that off. Now, some people have more. Some folks say, Don, I've got a mortgage that's $240,000, and the reverse mortgage is only making $40,000 available. I said, well, it didn't make enough to pay off the mortgage. But when we get to the 5 strategies, I'll tell you what that client can do and what many others have done. So if you're listening, you want to stay tuned till we get to those strategies. Yes.
All right, absolutely, stay tuned. So I guess my follow-up to that, so now that I know that I'm eligible and roughly how much money I could get off of my reverse mortgage or my HECM, whatever you want to call it, how do I actually get the money?
Sure. So there are 5 ways that a reverse mortgage can be distributed to a client. Number 1, we can back up a dump truck, and you just say, pour the money in singles in the front yard.
Okay.
We don't do that in Philadelphia area, but maybe in Vegas they'll do that. So you can receive the money in a lump sum. You can't have it anymore and all in 1 year, but it's over a 2-year period. So you can receive it in a lump sum. Number 2, you can receive it in a line of credit. We're going to talk about that more as we move through this broadcast, a line of credit. Number 3, you can receive it as a monthly tenure payment, T-E-N-U-R-E, which means, Don, I'd like to receive a certain amount of money every month for as long as I'm living in this home and have this mortgage open. That's called a tenure payment. Number 4 is a term payment. Don, I don't need the money for as long as I live. I just really need it for the next 6 or 8 years or whatever. I just want a certain amount of money to last this long. That's a term payment. And finally, it's a hybrid. The hybrid just simply means, Don, I want some in a lump sum, some in a term payment, and some in a line of credit. So that's just a combination, and those are the 5 ways you can have the benefits of the reverse mortgage, or 5 distribution strategies.
So I've got 2 really important takeaways already. Number 1 is it's just a mortgage, and number 2, there's a variety of ways you can actually get your cash out.
Sure, absolutely. Now, those are great takeaways, Greg. And something that oftentimes, if your clients are looking, watching some star on television or I don't know who's on TV now, that you don't have time to explain all of that in 60 seconds or 90 seconds or 30 seconds. And so it's important, excuse me, that I think the people listening with you will have a financial advisor maybe or be connected with someone who's a professional in this, that you understand the breadth and width of the tool. Reverse mortgages or HECMs are not a product. They're a strategy that must be implemented and used in conjunction with your insurances, your annuities, your income, and your total retirement income plan. That's
it's just another bucket of money.
That's right.
Yeah. Okay. Great. So let's just say, Don, I love this concept. I need it built into my plan, and I go ahead. I decide I'm going to get a HECM. And what I would like to know is, what are my responsibilities after we go ahead and get that HECM?
Sure. One of the questions that comes up all the time is things get a little spooky with people. I mean, you just ask someone, just mention reverse mortgage at the family reunion and see what happens. Oh my God! And folk will jump, and people will leave the chicken wings and the barbecue and potato salad, go running.
It's worse than telling them you just got a job selling life insurance.
Oh yeah, and so the reason for that is that a lot of times people have heard this story. Or you look over in the corner there. Where's the corner? You look over and there's Uncle Harry, and he's living in his your cousin's spare bedroom, and people are whispering, what happened to Uncle Harry? And someone says, oh, he got that reverse mortgage, and he lost his house, and he's in Tracy's spare bedroom. And everyone goes, oh. And that's the story that you hear, right? And we'll cover that in misconceptions. But I once did a workshop, and there were some legislators from Philadelphia, and they heard me say this. I said, no one's lost a home or been foreclosed on because of a reverse mortgage here in Greater Philadelphia. And the man stood up and he said, Don, that's not true. I said, no one has lost a home, sir, or been foreclosed on because of a reverse mortgage. And he said, no, the people come to City Hall all the time. And I went on to explain the 4. Here's my thing. 4. Here are the 4 responsibilities. Number 1, when you get a reverse mortgage, it has to remain your principal residence. You can't move to Florida and put your cousin Larry in there. That would be fraud. So it has to remain your principal residence. Number two, you've got to take care of the property. You can't let a tree fall through the roof and not fix it. Number three, you have to maintain homeowners insurance or hazard insurance, basic fire insurance. And finally, number four, you have to pay your property-related taxes.
Okay, so all normal stuff that you're going to do anyways as a homeowner.
Well, it's not spooky, but it doesn't come up in the story. So let's go back to Uncle Larry, who's living in Tracy's spare bedroom, and they said, oh, he got that reverse mortgage and he lost his house. Both of those things are true. He did get a reverse mortgage, and he did lose his house, but they're not correlated. The reason he lost his house is because he didn't pay his property taxes for 3 or 4 years, and the township or the municipality or the city took action. Well, that's not a good story. You don't want to share that with the family. You want to say, oh, that doggone reverse mortgage, I'm sorry I ever did it. And but the majority of people, and this was confirmed by the folk here in Philadelphia, because they called me and they went back and said, Don, you're right. We discovered that the people who came in with complaints, 100% of them had a judgment of foreclosure that was authorized by the city of Philadelphia because they hadn't paid their taxes.
It has nothing to do with the HECM.
Nothing at all. But that doesn't make a good story. That doesn't sell newspapers. You need something spooky or salacious to make it good. And but once you find someone who'll tell you the truth and be reasonable, you understand it's just a mortgage. You're in Las Vegas. I don't know what happens if in Las Vegas you don't pay your property taxes for 2 or 3 years. I imagine they do something. And
you won't be able to stay there too long.
Yeah. All right. So they're your responsibilities.
So let's just say, Don, that I go ahead and I decide I get a HECM and I stop making my mortgage payments. Everything is rosy, and then I decide in 10 years, hey, I want to move. This isn't my forever home. I thought it was. How do I repay the loan? I assume I have to repay it, right?
Sure. So and I would say this question came up. I was in Burlington, Iowa at a workshop, and a person said, Don, should I get a reverse mortgage when I'm absolutely certain this is my last home? Mm-hmm. And I would say, how would you be absolutely certain of that? Is your last name Nostradamus? Or are you some sort of biblical prophet?
Right.
I said, how in the world would you know that? I said, here's what I've begun to say. Because a reverse mortgage is a strategy, not a product, it's a strategy or a tool. Would you buy homeowners insurance on your home if you knew you were only going to be there 5 years? And most people say, well, yeah, I would do that. I said, why? What if you had plenty of money to insure your house? I said, and they said, well, Don, it's good risk management. It makes sense. And I said, so if part of your strategy for using your housing wealth is to provide a type of insurance that will cover in a moment, then you would want to have that in place from day one. I said, now, if that wasn't your strategy, maybe you weren't drawing from your portfolio or some of the things we talk about have no bearing on you, then maybe you don't want to have a HECM in place. So it's not so much how long you're going to be in the property, but it's what strategy and tools incorporate in your current retirement income plan, and does housing wealth fit into that?
Right. And I love how you kind of describe that. Is this part of your overall strategy? So you've got clients and they've got the annuity that they may live off of, and the pension, the Social Security, and the assets, and the IRAs, and the Roth IRAs, and the HSAs. You've got all these different buckets of money, and everybody wants to overlook one of the biggest buckets of money, which they live in, and they don't incorporate that into their plan. I think it's a great strategy because I love to do what I call front-loading my clients' retirement. I love to have them enjoy it while they're 60 and 70 versus, hang on to it until they're 85 and they don't want to travel anymore.
Right. That's right.
Yeah. So, Don, let's go ahead and dig right into it. You've got 5 simple strategies that HECM can be incorporated into retirement income.
Let me go back. Because I didn't fully answer that question. I got excited in my own storytelling and got carried away. It's a hazard of growing up in Kentucky. You just get carried away. When does the loan get repaid? Is the question. And because this ties into a very common misconception, but the reverse mortgage becomes due and payable when the last surviving borrower permanently departs the home. That is when they move or when they decease. Now, what gets repaid is whatever money we advance to you plus any accrued interest if you hadn't made a payment gets repaid. And listen, 100% of the remaining equity passes on to your heirs or your estate. Let me explain it this way. Let's say you have a client that lived in a $200,000 house, and she took out a reverse mortgage of $100,000 and paid off her mortgage. So from day one, she owes me $100,000. Well, she goes on and she doesn't make a payment, and it's years later, and now she owes me $200,000. And she dies or she moves, and it's 15 years later perhaps. So assuming her home has appreciated, her home could be worth $300,000 at that point, and she owes me $200,000. Her heirs or her estate sell the house, $300,000, pays back $200,000, and there's $100,000 remaining. That passes on to the heirs or the estate. That's typically what happens in a reverse mortgage. Well, someone says, Don, what happens if when Mama died, her house was only worth $200,000 and she owed you $200,000? I said, well, that's a break even, right? No harm, no foul. Well, Don, what happens if when Mama died, she owed you $200,000, but her house was only worth $100,000? She now owes you more than the home is worth. And I said, because this is a federally insured loan since 1988, the only recourse the lender has are the net proceeds from the sale of the house, which means the lender only gets $100,000 even though she owed $200,000 because it's federally insured. There's no judgment, there's no obligation on part of the heirs or the estate. They walk away scot-free. And that's how the reverse mortgages are repaid. So typically, children sell the house, pay what's owed, and they pocket the difference. The children can refinance the home. You say, I don't want to sell the home. Great. Go and refinance the home, pay back the reverse mortgage company, and retain the home. Or maybe mom had insurance or other investments. The lender just wants their money when the loan becomes due and payable. They don't want the house, so the lender doesn't take the home. So I wanted to say that, and we'll cover that in the common misconceptions as we end, but I wanted to make sure the listeners understood this. A reverse mortgage, folks, is just a mortgage. If I happen to, yeah, go ahead, Greg.
No, I was going to say you make an excellent point, and I knew we would kind of get to this topic at some point. There's a real quick story I love to share with clients. I've got a client up in Utah, and she's got this wonderful $250,000 house. She owes nothing on it. She's retired. She lives by herself. All of a sudden, the city comes in, and they say, hey, by the way, this gigantic boulder, this zillion-ton boulder that's behind your house, that's actually a hazard. So her property value will likely never go up. I mean, anybody who buys this house is going to have to contend with this massive boulder, possibly rolling and crushing them while they're sleeping. So the first thing I told her was, you need to go get and establish this HECM, because while your house may never grow in value, the HECM will grow, and I know you're going to cover that real soon. You could literally write a check to yourself when you're 80 years old for $500,000, and the house is only worth $500,000 possibly, right?
That's right. That's right.
Yeah.
And,
so we're going to get there. I just love that story because I think there are so many reasons that people need to consider these.
Absolutely. That's a great story. So let's talk about some of the strategies.
Okay, let's dig right in. So, Don, the very first strategy that we're going to discuss is actually creating a cushion. So what do you mean by creating a cushion? And just so you know, this slide we're going to leave up here for a little bit for the viewers out there so they can kind of dig deeper into some of those numbers as Don explains it.
So the reverse mortgage, one of the ways you can have the money as a lump sum, a monthly payment, or a line of credit. Most people understand a line of credit. Even if you've never had one on your home, you may want to have one in your wallet. It's called a credit card. Visa, MasterCard, Discover sends you this line of credit, and they say you have access to it. Use it as you want up to this whatever limit it has. So the reverse mortgage, as you're seeing on your screen right there, has a built-in line of credit. So one of the ways you can use it, so if you've got a home that's $200,000 or $400,000 or $600,000, as you see on the screen, and these are numbers from 2016, end of 2016, but interest rates haven't changed, so they still hold true, a 65-year. So if you notice, a $100,000 line of credit, if it's not being used, if it's not being accessed, it grows. It has a built-in contractually guaranteed growth factor. And so over the next 30 or 31 years, that $100,000 line of credit has grown to $608,000. If you had a $400,000 home and you got a $200,000 line of credit, it grew to $1.2 million, or $311,000 line of credit grows to nearly $1.9 million. That's at today's interest rate. If rates go up, then that line of credit goes up. Now, that's been spectacular. And folks said, Don, is that true? I said, it's absolutely true. It's so true that the AARP Policy Institute went before HUD and said, you know what, we may need to do away with this because people are using this in a way that we never thought it would be done 30 years ago. Exactly what you said earlier. So it's absolutely true. So creating a cushion, when you say, Don, you've got your income and you've got your investments and you have your insurance, includes annuities and all of this, what difference would it make in your retirement if you were able to create another cushion that's going to be growing for you, not tax deferred, but tax free, to use for spending shocks that will come up in the future? We're all going to have spending shocks. That commercial life comes at you fast. You don't know what's going to happen to you around the corner. Hopefully you're well, but isn't it a wise thing to have an accessible bucket of money, a pot of money? Greg, there's this term I heard several years ago, and most of the people listening on this call who are homeowners, you probably have homeowners insurance. You've probably had it for 20, 30, 40 years. Yep. And I asked the people on the phone call or listening here, have you ever had a fire in your house? Did your house ever burn to the ground? And most people say no. I said, a small fire? No. And I said, but you've been paying $500, $1,000, $1,500 a year for the last 20, 30 years, and you've never had a fire? We should set your kitchen on fire or something to get our money's worth. And I said, why would any reasonable person carry insurance that has cost them tens of thousands of dollars for something that probably will never happen? Because it's good financial stewardship. Yep. Right? That's a great word that you use. Now, that's homeowners insurance, and there's car insurance. Well, this financial cushion, this line of credit, that's a form of insurance, and it's called equity insurance. That's a term that I heard Dr. Jack Goodentag at the Wharton School use. Equity insurance. What is equity insurance? Equity insurance, watch this, is guaranteed access to the appreciating equity that's in your home, regardless of your home's value, regardless of your credit, regardless of glitches, your assets. You have access to those figures that you saw on your screen earlier. You have access to that in the future, regardless of these other things. And I can tell you something. Your house may not burn to the ground and you may not total your car, but the probability that you're going to need $200,000, $300,000, $400,000, $500,000 or something over a long retirement, that's a pretty big probability. So that's the first strategic use of this, is creating a cushion for spending shocks.
Another thought that popped into my mind, Don, and maybe you can comment on this, is you said spending shock, and the first thing that I thought of is long-term care medical expenses.
Yes, sure.
I imagine this is a great way to plan for those.
Most people don't plan for that, Greg. I don't have to tell you that. I'm preaching to the choir there. And I think you were Lutheran at one point, so you may not have had a choir. We were Baptists. So
oh, no, we had the choir. I was in it.
But one of the things that people have not planned for in their retirement are the two biggest expenses. Number one, out-of-pocket medical costs, which Fidelity had a study that put that at $250,000 for a couple retiring today. And so that's out of pocket. And the second is the 70% of retirees who will need some form of long-term care, with the average cost looking to be around $130,000. So we're looking at $200,000 to $400,000 or $500,000 and a spending shock that most people will have in some way, shape, or form, and they're not prepared for that. And I want to say this to the listeners, that establishing, when you buy homeowners insurance, I pay for that every year, $1,200, whatever it is, every year, and I've been doing that ever since I've been a homeowner. That's out of my pocket. That's real money. A reverse mortgage requires the typical borrower to pay about $500, $300 to $500 out of pocket to establish this equity insurance. Now juxtapose that to the amount of money you've been paying out of pocket for your car insurance and your homeowner's insurance.
It's
So
cheap.
for this is the cheapest insurance I think you'll ever buy in your life, and the one that I know you're going to need in the future.
Yep, yep. Okay, so let's move on to the next simple strategy, which is near and dear to my heart. It's creating a buffer. So what do you mean about creating a buffer? To what?
Well, this is for people who really have managed wealth, assets working in the market. And if that slide is still up, that's a picture of the market, the ride that we take here and there, up and down. And when you're younger, I'm 51, I can sustain that ride because I'm not at the top of the mountain yet. I'm not taking money out. But once you get to the place of retirement, this ride, there are not a lot of 80-year-olds on the roller coaster. There was a place right outside of Cincinnati called Kings Island, and we had a roller coaster called the Beast. When I was growing up, it was the highest, fastest, longest, all wooden roller coaster in the world. And there are a lot of teenagers on that thing, but very few folk who were 70 and 80.
Yeah, I'll pass too.
Because the dips in the Beast, and that really is a picture of the market for a lot of folk. You want to have some money in there, but you've got to be realistic. So if you've got managed wealth, which certainly is expected, what do you do when the market dips? How do you preserve? So one of the strategies that we can't go deep into, but a very simple strategy, is this. If you were to not take any money out, any distributions in the year following a negative return in the market, that next year you said, I'm not going to take any money out of my savings. Mm-hmm. If you did that every year we hit one of those dips, the preservation of your portfolio would be substantial. Yep. But the challenge is, well, then how do I live in the years where I'm not taking any money out? Mm-hmm. Well, you want to find a non-correlated asset, meaning you want to find some money that's not tied to the ups and downs of the market. That could be life insurance. That could be something else. But most people have access to housing wealth. That is, if you were to establish that line of credit that we just talked about as strategy number one, mm-hmm. the years following a negative return in the market, instead of pulling it out of that and locking in the losses, you pull it out of your line of credit, and then you give your account time to recover. And if it recovers well enough, you put the money back in and you start over again. That in and of itself creates a much better retirement experience, a much bigger inheritance, and a much smoother ride for your money. It's a powerful strategy, and I keep saying this. And it's something you can do for $500 out of pocket. To have this backup insurance plan is a wonderful way if you're dealing with managed wealth. Well, what were your thoughts on that?
I was going to say, Don, I wholeheartedly agree with you, and especially, and even more importantly, early in retirement. So if you're dealing with some, younger retirees in their 60s, the biggest risk that they face really is that sequence of return risk, or it's the sequence of returns that the market gives them with their portfolio. So if they suffer through one of these nasty market drops, and they're still pulling money out of their portfolio, they can't recover from that. So this strategy essentially says, hey, when the market is bad, I am not going to pull money out of my portfolio. In fact, I'm probably going to rebalance and be buying stocks while they're cheaper. Instead, I'm going to live off of my HECM.
That's right. That's right. A powerful strategy. And Greg, you as a financial advisor and a person that's retirement income focused, mastering wealth, my question is the consumers who are watching this, there may be some advisors who are watching this, you recognize this as a wise and prudent strategy of setting up a HECM to serve as a buffer against this type of volatility. Mm-hmm. Why do you think advisors like yourself or consumers may have been maybe a little slow to get on board with this?
The same reason I was a few years ago. I think it's just a lack of knowledge, a lack of education, a lack of really understanding. And honestly, what sold it for me was when I realized that the line of credit will grow. To me, the deal breaker was I don't want to pay money and set this up, and it's just going to, be a hassle. And then once I realized that the line of credit grows, in my mind, I'm looking at doing a plan for a 65-year-old couple, and I'm thinking, hey, you may never touch this HECM. You may never touch a dime out of it. But
Right.
at age 75, you'll have already enjoyed your younger years in retirement. You may need to touch a little bit of it then. So we're just going to build it as your, what I call, it's the last arrow in the quiver. It's the final backstop.
Mm-hmm.
And to me, it's insurance. Just like you said, Don, I tell them, listen, I don't care if this thing's going to cost you $5,000 to set up or whatever the number is. To me, I take that $5,000, I divide it over the next 30 years of their life, and it's super cheap insurance.
Right, right, absolutely. Well, thank you, Greg, for being proactive in that. Thank you, Elise. I'm an old Baptist preacher, so I get a little dried out here.
Oh, no worries. So while you're taking a quick sip of water there, so the next one that you're going to kind of discuss with us is actually going to be creating a cash flow. So we talked about maybe taking the money, maybe not, and all the different ways, but explain what we're looking at here with the cash flows.
These next two of the 5 strategies is very important. The typical baby boomer, those born between 1946 1964, they're going to live longer than their predecessors. They haven't saved enough, and they're highly indebted, which was somewhere between 50 and 68% of baby boomers are carrying some sort of mortgage payment, home equity loan, second mortgage payment into retirement. And a fellow said to me, "Oh, Don, is that true?" I said, yeah, the numbers bear it out. And I said, but next time you're with a group of folk who were born between 1946 and 1964, just ask them, how many of you all have a mortgage or a home equity loan or something against your property? Nearly every hand will go up. And so they're coming into retirement having this. So I want you to think, those who are listening, that about coming into retirement, having some savings, but having a monthly mortgage payment of $200, $400, $800, $1,500, right? Maybe you got it when you were 55. And now you're 65, you say, gosh, I got 20 years left on this. And I'm retired, and I've got a $1,400 a month payment for 20 years. Here's the question. I want you to answer this question. Ready? I'm going to look into the camera. What would life be like for you? What would your retirement look like if you did not have to make that monthly mortgage payment? Think about that. Yep. Think about that, those who are watching. What would your retirement look like if you did not have to make that mandatory monthly mortgage payment? Now, I can't hear you.
Everybody's going to raise their hand and say it would be tremendously better.
But when I asked that question, a few of you did like this. You said, your shoulders lowered, and you just let out a relief, right? Some of you said, it doesn't matter. I've got something for you in strategy number 4. But the truth is, if you had an extra $1,200 a month, what would that mean? That may mean you didn't have to draw so much out of your managed wealth. If you simply eliminated a mortgage payment, like the picture that was on the screen, here's, and it may go back up there now, but here's a person,
we'll put that back up.
And we're showing this person had $300,000 when they retired. And they were going to draw out $2,000 a month beginning at age 65. That was unsustainable. And so they were going to run out of money at age 81 with that type of strategy. But they had a monthly mortgage payment. They were paying $800 a month, and they had 20 years left on it. And we said to them, if you did a reverse mortgage, and we simply exchanged your traditionally amortizing mortgage for a reverse mortgage, you wouldn't have that $800 a month payment. And if you didn't have to make that payment, then that means you don't have to draw down as much from your savings. And the waterfall graph that you saw said simply by eliminating a monthly mortgage payment, we extended the life of their portfolio 10 more years.
Gotcha.
See, 10 more years. Now, the question is, that may not be your concern, but some of you, the number one concern is running out of savings in retirement, and you have a monthly mortgage payment. Well, that's a way to extend the life of that. For others, you say, Don, if I didn't have a monthly mortgage payment, I could help my grandchildren with college. That $1,200 could be used for that. Some of you said, if I didn't have a monthly mortgage payment, in my retirement dream and the movie, I played golf 3 times a week. Now that I'm retired, I can play twice a month because it's more expensive. Maybe you get more lifestyle. Maybe you get more longevity. Maybe you get more legacy. or maybe you have more liquidity. Maybe you just save that money. But creating cash flow by eliminating a monthly mortgage payment has tremendous benefits to most of the people listening to this call. Now let's talk about those who say, well, wait a minute, Don, I've got a monthly mortgage payment. I'm comfortable. I'm okay with it. I don't mind it. I've got the cash flow to sustain it. Well, that's strategy number 4. Let's look at that.
Yep.
Strategy. Now, creating a deferred income. Now, think with me for a moment, those of you who have a monthly payment. And now listen, I'll say this like one politician once said, if you like your payment, you can keep your payment.
Okay. Got it.
Okay, so I'm not going to mess with your payment. You like your payment. You love it every month. You hug it. So I love your payment. I'm not going to mess with that.
All right.
But,
I'm dying to see where this is going.
So let's say you like your payment, and every month you've been paying $1,000 a month to such and such a bank. So that's $12,000 a year, and now you're 10 years into this. You got it at 55, now you're 65. You've paid them $120,000, and you call them up on the phone. You call them up and you say, hey, listen, I'd like for you to send me a check for $80,000. Just overnight that to me.
That's not going to happen.
You must have the wrong number. You said, no, I've been paying you guys for years. I'd like to get some of that money back. They said, no, you have to requalify and go through. We have to check your income and credit. See, folks, they don't give you the money back, do they? Nope. Now, what would happen? Listen to this. What would happen if you could take your mortgage and just exchange it for a HECM, right? Now, I don't want you to stop payments. I want you to switch partners, right? I don't want you to change payments. I just want you to change partners. So you're still going to have a payment, but we're going to have, instead of you being with Bank of the World,
yeah, right.
You're now going to be with the HECM Bank. So that $1,000 a month payment you had, you're still going to have it. Now, here's what will happen. Every time you make a payment on the HECM, your loan balance goes down until it fades out. Now, that happened when you were Bank of the World, wasn't it? Every time you made a payment, nothing different. So I'm not asking you to change any behavior. I'm saying make a payment because you like it. Now let your balance goes down. If you put that slide back up there, I'm going to show you on the screen. And so here's what happens. It's not in color, but the red line there at the bottom, I can't see because I don't have a color printer. But this shows what happens to a person that had a $400,000 home and had a $100,000 mortgage payment, paying $1,000 a month. When they got a HECM, we said to them, keep making a payment. And so the red line shows that every time they made a payment, their loan balance went down. So 10 or 12 years later, look what happened to it. It's done. They have no more loan balance. But the green line, folks, the green line is every time you sent in $1,000 monthly payment, we added that to your line of credit. Watch this. The line of credit today, at the time of this airing, is growing at around 6%. So your loan balance went down. Every time you made a payment, we added $1,000 to your line of credit, and that went up. So when you see that on your screen, when you see that, over time, now 10 years down the road, the $120,000 caused your balance to go down. Then you call me up and you say, Don, I'd like $80,000. And I say to you, what? That's all you want? I said, you've got $150,000 in there. And you say, what are you talking about, Willis? You remember that show?
Oh, my God, I grew up on that show.
and because, you know what happened? You know what we did, Greg? We took something you were already doing as a behavior pattern, making a payment, getting a tax deduction, reducing your principal balance. We took that, but instead we said we're going to change your partner, and every time you make a payment, we're going to put that in a line of credit. So down the road, you won't have $100,000. You could have $200,000, $300,000, $400,000, $500,000, $600,000. And on the chart that we had up, it says even the money that you had could even surpass the value of your home itself. Now, here's the question. if you're here and you're listening to me, you have a monthly payment and you like making that payment, why wouldn't you switch? Why wouldn't you change partners? Keep your payment, but change partners that down the road you could have access to $300,000, $400,000, $500,000, $700,000 when you need it. And the truth of the matter is, in retirement, you've got the go-go years. That's when you first retire, and you're salsa dancing, you're traveling. That's the go-go years.
Yep.
And then you have the slow-go years where you say, well, you know what? I don't want to do all that traveling, and then around 80, 85, you got the no-go years.
The no-go.
And that's when the money starts drying up.
Yeah.
But if you were strategic just for the first 15, 18 years when you had that payment, if you kept it and you end up with a huge pot of money, $600,000, $700,000 when you're 80 years of age, you're going to look back on something that cost you nothing.
Right.
You didn't have to change your behavior at all. And folk will look at you and say, why does Bill and Mary, how'd they end up with $800,000 in this extra pot of money? It's because they did something strategic and wise and thoughtful early on. So that's how you create a deferred income without ever having to change your behavior, your economics at all.
You just keep making your payments to a different bank, like you said, the HECM bank that they take the loan out for, and eventually at some point in time when you want to draw money, it's there for you to draw. Or if you just want to stop making payments, that could be an option as well.
Right, and I should say that the payments are voluntary. And so you say, Don, I don't have $1,000 this month. I said, that's fine. You're making a voluntary payment that match what you were making. You can make more, you can make less, you can make none at all. You've got payment flexibility, cash flow control, tax deductibility, guaranteed growth. And here's the biggest thing. You're creating equity insurance because down the road, you're going to need access. Who on this call could say to me, Don, I don't think when I'm 80 or 79 or 85, I don't think I'm going to need an extra $500,000 or $800,000. I'm okay. Yeah. Who would say that? Who would
I
say
don't know.
I don't know.
Not many people. Not many people at all. Yeah, and you know what? If you look at the alternative, Don, in that that kind of process that you described, where somebody gets the HECM now, it's set up, it's guaranteed, nobody can take it away from them because it's federally insured, right?
Right.
Versus the opposite. Let's say you make your payments, your house is eventually paid off, and at age 80, you want to pull money out of your house. Well, you did not set up the HECM. You were not strategic about this. Now you've got to go and try to find a bank to loan you money when you're 80 years old. You have no job. You've got, Social Security, maybe income. It's a lot harder to try to get a loan later in life than it is to set it up early.
Sure. Or some people, advisors have told their clients, well, listen, let's not do the HECM right now. Let's wait until you're 75 or 80, you're older, your house should be worth more, then you'll probably get more money. And the truth is, you will get more money, but as we'll see in a moment, the money you'll get 20 years or 15 years from now will never catch up to the money you could have gotten today, because the money today is growing at around 6%. So you'll get more down the road, but you're going to lose a lot more when you do that. So let's go to the fifth one, and let's land the plane here.
Yep, let's land the plane. Creating a right-sized retirement. Don, what exactly is a right-sized retirement?
A lot of folk have talked about downsizing, and many folk don't like that word, downsizing. No one wants to go down. Everybody wants to go up. And I said, well, it's not downsizing, it's right-sizing. What's the right size for your final home in retirement? How many of your clients, Greg, have homes and their children aren't coming back? You don't need all those bedrooms and square footage and the tax and
I keep telling them, the kids don't want your house.
Kids don't, and my last child is leaving in a month. I told my wife, change the locks and let's go. But my house is too big. I was just talking to my neighbor. I said, listen, I don't want this big house. I don't want the steps. I don't want all of that. So right sizing, as we put on the screen, here's just an example. And I've said to clients, I said, if there were a way that you could increase your cash flow, reduce your expenses, and add more money back into your retirement savings, would that be something you'd like to learn about?
Sounds good.
Okay, no, I don't want to increase my cash flow. I don't want to reduce my expenses. Get on out of here. Well, no one says that in their right mind. So the HECM, 1988, well, 2008, after the Great Recession, there was a new type of HECM called the HECM for purchase. The HECM for purchase was simply a way that allowed you to purchase your next home even before you moved in there using a reverse mortgage. Here's how it works. On the screen there,
Yep.
There's a client that had a house, $535,000, and they had a big mortgage on the property. And so the wife was concerned about longevity, that I don't want to run out of money. The husband was concerned about lifestyle. I want to play more golf than I'm playing right now. And I said to them, listen, let me show you a strategy. I said, this house is big. Are you open to moving? They said, yes, we're open to that. I said, if you sold your house, a $535,000 house that was on the screen, and we paid off the mortgage, you'd have about $400,000 left over and no mortgage payment. So just right there, we've helped the husband, because that $1,000 a month, I said, now I don't know how much golf you play, but that'll get you a few rounds and a hot dog after each of them. But the wife says, well, what about me? I said, so let's find there's a new gated community over here. It's $300,000, beautiful homes. And I said, they're just smaller, but they're gorgeous. And they said, great, Don, we've got $400,000. We'll just pay cash. I said, oh, nay. I said, do you really want to lock up 100% of your equity in a home, given what happened in 2008? And they said, no, we don't want to do that. Right. I said, let me give you a strategy. Let's use the HECM for purchase on your new home. So the new home was $300,000. In the example, the HECM for purchase made about 50% available, or $154,000. So $300,000 cost of the new house minus the HECM, $154,000, means the client had a down payment of $146,000. That's what they had to bring, $146,000. But they had $400,000 left over.
Yeah.
So out of the $400,000, they put down a down payment of $146,000, and they had $254,000 in cash left over to add back into their retirement savings. Well, the husband and wife were stunned. Now, we didn't know we could do this. And I said, yes, the HECM for purchase is the #1 way in America that boomers are rehabbing their retirement. So if you're listening and you're saying, if I say to you, would it make sense, right, just like I said to that family, to increase your cash flow? Well, how did we do that? By moving and paying off their mortgage, we increased their cash flow. Number 2, reduce their expenses. We went from this big house to a smaller house, newer appliance, less maintenance, and lower taxes. We reduced their expenses, and we added $250,000 back into their net worth, back into their savings. Everybody won't do $250,000. Some people can do more, some people can do less.
Right.
But if you can do that,
can go to work for them too.
That's absolutely. So the HECM for purchase is a powerful strategy that I believe every advisor, every person looking at this, if you're going to see a lot of folks to say, Don, I love my house. I'm committed to my house. I said, that's great. I said that sometimes the trade-off is you can have more house and less retirement, or you can have less house but a bigger retirement. What do you want? What do you want? And see, you got some, and so those are the 5 strategies: creating a cushion through a line of credit, creating a buffer to manage market volatility, or just withdrawing at the wrong time, creating cash flow by limiting a mortgage, creating a deferred income by making a mortgage payment but switching your mortgage partner, and here creating a right-sized retirement that you can add more money back into your savings. 5 supersized, powerful strategies.
5 great strategies.
Great strategies. Now, there are 31 altogether, but we're only going to cover 5. But if you just stop there, that's very important. So, Greg, let's land the plane here.
All right. Let's do that. We had talked a little bit, so far, but About when you want to go ahead and get a HECM mortgage. And I think I know the answer. It's probably as early as possible, but go ahead and explain what this slide on the screen is and, what's the best time to get it?
Sure. The slide on the screen emphasized what I said earlier. What's the best time, particularly right now, to get a HECM? Well, the top line shows a $250,000 home, and it's going to appreciate over time. That's the top line. And the two bottom lines, the blue one and then the gold one, show a client that gets a $125,000 line of credit. Now, the middle line says they got it today, they let it grow, and you notice over time it grows, even possibly surpassing the home's value. The line at the bottom is the person that says, well, I'm not going to do a reverse mortgage line of credit today. I'll wait because I'll be older and my house will be worth more and I'll get more money. And indeed, you're right. That bottom line says you got more money, but you never catch the top line. And right now, interest rates may begin to creep up. We've begun to see that with the new administration. There's economic uncertainty. And if interest rates creep up and you got a line of credit today, what that would mean is your line of credit would grow faster at a higher rate, and then the amount of money you would get from a HECM would be lower. So the gap would be even wider if you did that. So the optimal time really in this type of environment, and this has been borne out through the Journal of Financial Planning and Kiplinger's and Wall Street Journal, and most of the academic thought leaders agree that the optimal time to establish a reverse mortgage line of credit is early in retirement.
All right. And just to reiterate, Wealth Masters, and kind of drive that point home about the interest rates. If the interest rates are higher, you will not get as much out of a HECM, the value, because just like in a regular mortgage, if you're paying more in interest to the bank, that's less house that you can afford. So that's another reason with interest rates at historical lows that this is something you probably want to consider sooner rather than later. And Don, here's another chart that you created that just kind of reiterates the optimal point to get a HECM again. Can you kind of explain what we're looking at here?
Well, that was a waterfall graph earlier.
Okay.
And so let's focus on the chart before that, and we'll disregard that one. But really, it's right now, that one right there, it's looking at it sooner than later.
Okay.
And let me say a word about the world of the HECM sphere, the world of providers. I'm an educator. I have partnerships with other folk, but I'm an educator. But it's very important to the consumer who's listening that if you're dealing with someone who's treating a reverse mortgage as a product, they're selling you a product, you want to be far away from that person. And I mean that with all my heart. What you want to find is a HECM strategist, someone who's working preferably with a retirement income planner, or if you don't have a planner, someone who understands the principles of the HECM strategy so that you can optimize this. So, and in my nearly 2 decades of seeing this, there have been some folk who've guided folk in the wrong way that it would benefit them. If someone's saying you need to take that money out in a lump sum and put it in your bank, you want to run from that person. You want to run from that because that's self-serving to them. And so just a word on make sure you connect with legitimate, trained, retirement income reverse mortgage professionals that will lead you through a questioning and a coordinated process where they're dealing with your income, your investments, your insurances, and then how housing wealth fits into that, and that it's a long-term strategy and not a short-term strategy.
So if I could just kind of summarize that, what I'm hearing from you is this is not just any old mortgage. This has to be carefully considered in the grand scheme of your entire retirement, including your assets, expenses, incomes, liability, your goals and needs and wants for the future. This isn't just hey, go out and get a mortgage and forget about it.
Absolutely. Absolutely. The HECM and the HECM specialist, I think, is a rare breed. There's somewhere between economists, advisors, pastors, social workers. It's a whole world. But it's a strategy, folks. You got to understand that. You can't get this in a 60-second commercial from a TV star. This is something that requires really some coordination, some questioning, and making sure that it's in your best interest, and it's a coordinated strategy with all of your other assets. And so make sure you deal with the right one. I think some of my contact information will be there. I'm happy to point you But whether you do that or not, make sure the person you deal with is not telling you about a product, certainly not telling you to take it out in a lump sum, because I don't think that's the way you need it unless you're paying off a big mortgage. Make sure it's strategic in its usage.
So, Don, I think, going back to my original admission, that I really, up till a few years ago, didn't know a whole lot about the HECM. I think it was mainly because of all of these misperceptions and myths. And every time a client walks in the door, I hesitate even mentioning a reverse mortgage because literally you see them kind of shut down and cower and they don't want to hear about it. So can you just kind of go over some of these misperceptions and dispel them?
Sure. There, and we've covered a lot during the session.
Yep.
And
we have, actually.
But let's.
I'm going to start you off. How about that? The bank will take my home.
Yes. Yeah, I hear that often. And I got to be careful. Every now and again, someone at church, they say, that's the guy that sells reverse mortgages. Go get him. Take him out back, Pastor. Get him.
No.
Well, and we hear that. Oh, no, that's that loan where the bank gives you the money. When you die, they take your house. And that's not true, folks. We've covered that. Because 4 words. What is a reverse mortgage?
It's just a mortgage.
It's just a mortgage. The bank in a forward mortgage or reverse mortgage doesn't want your house. They want their money back. I've got a mortgage. If my wife and I happen to pass away, my children are going to sell the house, pay back Bank of the World, and they're going to pocket whatever's left over. And a reverse mortgage, that's all that happens. It's a mortgage. At some point, you're going to owe money. At the end, the children are going to settle the estate, sell the house, get the insurance, whatever, pay back what's owed, and they pocket the difference. The bank doesn't take the house. They don't want the house. Close on the heels of that is the Uncle Larry story is, that reverse mortgage, you got to be careful.
Right. Because
you could lose your house. And I say, who do you know lost their house? Oh, I know. Last time I was with my cousin, Uncle Larry was in her spare bedroom.
Yeah.
I said, listen, you've got to pay your taxes, keep insurance in force, live in the house, and maintain it. I said, did Uncle Larry do all of those things? Oh, yeah, I'm certain he did. Yeah, right. Ask him if he paid his taxes. See, he may not tell you the truth, but see if he looks down. If his eyes go down, you know he didn't pay it. Well, that's another misconception that we get often. Another one is, you can't get a reverse mortgage if you've got a mortgage already on your property. No, that's not true. That's really had been the number 2 reason that people got a reverse mortgage, was to eliminate an existing monthly mortgage payment and get rid of that. A common prevailing theme oftentimes for some of your clients are those who have some means, the mass affluent, is that, reverse mortgage is only for those who are house rich and cash poor. It's only for poor people.
Right.
And I say, well, listen, let me ask you a question. I want you to be honest with me. And Mrs. Rosen, are you 100% certain you're going to have a great retirement? Now, those who are listening to this call, you're right there. I want you to answer this question. Are you 100% certain that you're going to have a great retirement? No, most of you are not. Now, listen to this last question. If there were a proven resource that allowed you to increase your cash flow, reduce your risks, preserve assets, enhance your liquidity, and even add retirement dollars back into your savings, if there was a proven resource to do all of that, would you want to know about that? And you said, Don, absolutely.
Yep.
I said, okay. Now, you told me you don't want a reverse mortgage, or you're skeptical of it, but you want the 5 things a reverse mortgage can do.
Yes. You could call it a purple cow, and they'd probably go, yeah, I want to get a purple cow mortgage.
And so, right. So if you want to increase cash flow, reduce risk, preserve assets, enhance liquidity, and even add dollars back into your retirement savings, look at where the majority of the wealth lies. The U.S. Census Bureau said that 60 to 68% of most Americans' total wealth is in housing wealth. Did you hear me? 60 to 68% is in housing wealth. Now, if you don't know how to leverage that housing wealth to create a sustainable retirement income, then you may live in a state of uncertainty, right? You just told me, you right there, you just told me that you were not 100% certain that you're going to have a great retirement. A reverse mortgage may not make you 100% certain, but it may get you closer than where you're at now. Don't you owe it to yourself to get all the answers, all the possible proven solutions and strategies that could help you? I have 5 friends who have cancer. 2 of them are no longer with me. And of my 5 friends, and then we talked about this, and I use this example with their blessing. And I said 2 of them went for alternative strategies. One went to Mexico, another one went such and such a place. That was fine. We believe in that. But all of them, when they went to their oncologist, imagine going to an oncologist and they said, I think we're just going to have to do surgery and amputate. And you say to them, well, should we wait a little bit, see if it grows? No, we're going to amputate. What about chemo? No, what about it? What about radiation? No, we don't talk about that. We're just going to amputate. Well, you would sue that oncologist. That would be malpractice to say they're not giving you all the possible strategies, whether you like them or not, you see. So housing wealth must be a part of a retirement income strategy. Whether you have an advisor, your advisor needs to look into that. They have to know a minimal amount about this because it has an impact. Or if you're a do-it-yourselfer and you're just watching this by yourself, you owe it to yourself to understand how this works and to work with a qualified reverse mortgage retirement income professional. You do that. And then so I think we've covered all the other myths and misconceptions. You should be able to go into the next barbecue or family reunion. I mean, just loaded for bear.
Yeah. Guns a-blazing, ready to go with your reverse mortgage info.
And if someone says something to you, just stop and say, wait a minute. Say, listen, it's just a mortgage.
It's just a mortgage. I love it. And you know what? Actually, as I said Purple Cow Mortgage, I got to thinking to myself, a lot of times I wish I would just say Purple Cow Mortgage to clients because they probably wouldn't be so, I can't do this. I can't do a reverse mortgage. And then at the end, explain to them, well, it's actually called a HECM or a reverse mortgage.
Well, here's what I say to folks, to advisors and to the consumers who are watching and you're listening. Don't tell people you're doing a reverse mortgage. Say, I'm doing a new reverse mortgage, because really that's what it is. Say I'm looking into the new reverse mortgage because it is newly restructured, or say I'm looking into the home equity conversion mortgage. If you call it a reverse mortgage, that's like calling here. Here this is. You see what that is? Yeah. This is a computer.
Yes.
I mean, exactly. I can bring stuff out of the airways and it magically appears on this screen. And I didn't have that. I didn't have this. 20 years ago. 20 years ago, all I could do was make and receive phone calls. See, can I really call this a cell phone? I can't.
No.
It's a mobile computing device, right? Yeah. We just call it by that name. The reverse mortgage is like this.
Yeah.
It's so much different than what you may have imagined that it does a lot more than making and receiving phone calls. There are 3.9 million ways to use this thing.
Right.
And so many with the reverse mortgage.
Well, Don, our job here is to, as I said in the opening mission statement, is to educate and empower people with all of these tools and tips and tactics and strategies. And this clearly, I mean, you're an expert, and this clearly has to be a strategy that's considered. So as we kind of bring it all home, Don, can you just kind of hit on some of these main takeaways that if you're going to leave the viewers with anything, you need to think about these 3 things?
Sure. Let me, I just set that away because I don't know where our time is. The main takeaways, I've said it 10 times, it's just a mortgage, 4 words that will get you out of any bad. If you get cornered in an alley and someone says, take it back, you say, it's just a mortgage.
Okay.
But the takeaway, you won't lose your home. You're not going to lose your home. You're required to live in the house, pay taxes, keep insurance enforced, and maintain it. Those are your responsibilities. And don't you already do that? That's not anything new, is it? You can use the proceeds. The reverse mortgage was designed that you can enjoy a long retirement. It's designed that you can enjoy a longer stress-free retirement by using all of your assets. And the third takeaway is the earlier you establish, it's been proven, I should say this, it's been proven that the earlier you establish a HECM line of credit, the more advantageous it will be for you. So those are my key takeaways. I think they're on the screen as well.
Yep. No, Don, that was great. Thank you so much. So for the Wealth Masters out there, Don, can you just share a little bit, if people want more information on the HECM, the reverse mortgage, the purple cow mortgage, whatever you want to call it, can you please share with our viewers out there how they can reach you?
Sure. You can always email me at askdongraves@gmail.com. That's an easy way to get to me. Twitter at askdongraves. Book Ask Don Graves. LinkedIn, Ask Don Graves.
And all of these links will be on your speaker page as well, so they can just point and click. Yep.
Or if you want to, I write about this every week. I do videos on my education site.
Yes.
AskDonGraves.com will get you there. AskDonGraves.com. So you got a question? Ask Don Graves about reverse mortgages.
Don, you've got a great YouTube channel. I did a little bit of research as I was preparing for this, and I love your YouTube channel and all the videos you put out. You are definitely an educator. I want to thank you so much for your time today, Don.
Thank you, Greg Phelps. I appreciate you.
So for the Wealth Masters out there, thank you for sharing a little bit of, or learning a little bit about the HECM reverse mortgage. I always like to say in signing off that either you control your money or it will control you, and I can't think of a much better strategy for you to consider about actually taking control of some of this untapped wealth as you enter retirement. So consider the HECM mortgage, do a little bit more research, and ask Don Graves. In fact, you can probably just go on Google and type in Ask Don Graves. You'll get all of his stuff. That'll pop up right there.
Yep,
so Don, thank you very much.
Thank you, Greg.
All right, this is Greg Phelps signing off.